Good afternoon. My name is Kent Scornia, President and CEO of Krilogy, and I'm here with my partner, John MacArthur, Chief Investment Officer here at Krilogy, and this is your July market perspective. Johnny, great to be with you again.
Great to be here.
How you doing?
Yeah, I'm doing great.
Yeah?
Doing great.
Good summer so far?
Summer has been really nice. Yeah.
Well, the market's been nice.
The market has.
Up 18% for the year for the S&P.
NASDAQ's up 37, 38. Yeah.
Pretty incredible year so far.
It really is incredible. Yeah. It's crazy. We had this conversation in one of our daily research meetings, but when we did our outlook kickoff in January, Jamie Setley introduced a seasonality script, pre-election year.
I recall.
And it's followed it to the T. It wasn't predictive, wasn't meant to be predictive, but it's amazing in hindsight that it's followed it almost to the T, looking back historically. So yeah,
and a lot of questions about, we're through some earnings season here.
Yeah.
Earnings are remaining positive. They are. Mm-hmm. There are some surprises. They're not as high as they were a year ago, but
right. Yeah, they're
eroded. Trending.
They've eroded, but not imploded.
Right.
And that's been welcome. It's been less bad, than feared, and I think that's really been a big key. That in conjunction with consistency around declining inflation, of course, which influences Fed policy. So I think the fact that earnings have really started to stabilize, and granted, the bar has been set pretty low.
I was going to say, if you're leading an S&P 500 company, you set some pretty low parameters on earnings. Because you had the opportunity to do that.
Companies have done a masterful job in that way, which is not surprising. It's the best run companies in the globe, really.
Most talented people running the best companies.
Yeah.
So, has the Fed orchestrated this soft landing?
They've done a really effective job. Obviously, irrespective of opinion, price has dictated a lot thus far in markets. I think for us, it's not a. There was always humility around the timing of an eventual downturn. I think that's still in place. It's hard to argue with the traditional measures that have had such a unblemished track record historically not working. I think it's just a function of the timing around it.
You're speaking of inverted yield curve and things along those lines.
Yeah, inverted yield curve. It is a big one. And it's really, in this day and age and society that we live in, I want information, I want it to happen now. There's just such a kind of a short attention span or kind of runway, if you will, for things to play out, particularly when the financial media is on day after day after day. It's kind of, in the kids reference on a vacation trip, are we there yet? And the answer is no. It's exactly just, it just takes time to play out. And I think, who knows? It could be well into 2024, but a lot of those classic indicators still show that we'll get it. And, I think the other thing that we've really not touched on in these prior monthly videos is the recession is announced typically when the yield curve uninverts. So we're still at a pretty meaningful spread in yield curves. So whether we're talking about 3-month T-bill versus the 10-year Treasury yield comparison, or the 2-year Treasury versus the 10-year, they're all inverted.
Yep.
And they can compress really quickly. We're just lacking the catalyst, fortunately, to allow that to happen. But once that uninversion happens, that's typically the announcement of a recession. And obviously it's been pushed off. But, I think the other, outside of economic data, the other thing that we've seen, and part of this, I think, is a function of the liquidity bazooka that's still in place. I mean, the Inflation Reduction Act, $1.7 trillion in spending, that's happening.
Right.
So I think that's, when we start to consider those factors, I think those are some things that maybe weren't collectively being considered by the market participants as a whole as we look back 6 months.
Yeah, and it's hard
6 months.
It's hard to really predict how long it takes for $8, arguably $10 trillion invested in the economy over the last few years to burn off.
Right. Absolutely.
You know, and I think the anticipation was going to burn off faster, and
Right.
this recession's coming. But,
Yeah.
people put it in their pockets. Companies put it in their pockets. And
Yeah.
maybe the burn off is just a little bit
Sure.
less as volatile as we expected.
Yeah. So we still, to answer your question, we still think a recession is in the cards, and it's just, it's just later. But risk can happen fast, and credit events can happen fast, and it's unpredictable, right?
It's interesting because I think I said two videos ago, the market climbs a wall of worry, and now I feel as if during the summer it's more complacent. There's some broadening of some leadership.
Absolutely, yeah.
And it feels a little bit of a complacency in the market right now.
There's been excitement around declining inflation, AI.
AI is
what
a
does
big
that
one.
mean?
Everyone's going to make money off of AI. So they say.
Right. Yeah. To see the direct impacts from AI, that's just going to take time. How it's monetized, and the productivity enhancements, and what does that look like? But what are the trade-off if job loss and ultimately consumption decline because there are less humans
to do the work?
Yeah.
Absolutely.
Those are all X factors. But we were talking earnings outside of economic data. The earnings kind of basing has just continued to push out.
Right.
So, we've seen what looks to be a bottom in earnings since the market lows that happened in October, really through Q1. But what's happening is we're continuing to see lower and lower expectations going out, Q3, Q4, Q1 of next year. So, I think our view is it's consistent with that seasonality pre-election year trend too, that there's kind of the potential for this kind of longer stagnating period, and that we're really lacking the catalyst to see this meaningful upward trajectory in earnings, which will ultimately propel price from here. Because if we take forward earnings on the S&P, let's call it $232 on a 12-month go forward, and price is 4,600 on the S&P. I mean, that's almost 20 times earnings.
Right.
For a risk-free rate north of 5%, that's rich.
Yeah, that is.
And so valuation is never a great, timing indicator, but it is an indication that sticking to discipline and valuation mattering as we go forward is going to continue to make more and more sense.
What's our friend Paul Gabriel saying about the fixed income markets?
Yeah, Paul has, as he likes to say, there's income and fixed income again. When you can look at the 10-year Treasury and get 4% yields with what we feel is a very probable negative correlated offset to equity risk,
right?
It's attractive. Everyone's enamored with the short end of the yield curve at 5% plus, which makes sense in a portfolio as well. But if you can lock in and kind of lengthen duration through treasuries, when that eventual recession plays out, again, having no visibility on the timing of it, that's when you have the ability to not only get 4% plus yield, but
nice capital appreciation.
That's
Absolutely.
right. I think and that's why last year the risk was really inflation concerns.
Correct.
Now it's more economic stability,
right,
and economic strength going forward. So the offset that treasuries can provide to equity risk now versus then is more legitimate than it's been in some time.
You and I are getting longer in the tooth, 20, 25 years in the business now.
Mm-hmm.
I can remember really early on in Krilogy's existence, the international space, in terms of the portfolios, was the leader.
Yeah.
Beating the U.S. year over year.
It's been a long time.
It's been a long time since that happened. Is that going to come back?
We think it will.
Longer term?
It's a very unloved space. I would argue that on a secular basis that it will. I mean, not just valuation based. I mean, in fact, developed foreign and emerging markets are hitting 52-week highs today.
Right.
And so if you look at the currency overlay and, peaking US dollar likely behind us, valuations, growing economies, I think the recipe is there for. And
they were a little bit late. Their central banks were a little bit late in the reaction to inflation and those sort of things compared to the U.S.
Right.
but they have caught up.
Right.
Their policies have been in place for quite some time.
Yeah, I think it's interesting too. And it all relates back to earnings over time.
Yeah.
And we're seeing in our work, we're seeing much more meaningful upward earnings revisions internationally
Yep.
relative to the US. We're seeing a stabilization in the US, but we aren't seeing the upward revisions that are really going to be important to not only propel higher prices, but even to support current price,
Absolutely.
frankly, at some point. So I think the ingredients are there. I think also when you recognize the lack of ownership, home country bias.
Right.
Again, it's an important cog in our opinion of a portfolio, but it's interesting anecdotally. If you ask most clients about the case for international, everybody has the recency bias,
It is. It's challenging.
right? The
Yes.
last 10,
challenging
15,
for all
20
of us,
years.
really. And you and I have lived it for so long.
Why would I when Microsoft and Apple
That's
and
right.
Amazon have done what they've done? But I think that's part of the
Right.
challenge.
I'm holding an iPhone, an Apple iPhone.
Right.
Why would I not invest in a U.S. company,
Right.
a strong U.S. company? But when you're doing portfolio modeling and when you're working
it's
through
important.
the actual fundamentals of portfolio, international piece is a key player.
And you mentioned which is absolutely right, the broadening out of the markets. We talked about that a month ago, and
Right.
that's really taking hold. But international investing is also synonymous with value and cyclical commodities,
Correct. Yeah.
dividends, and we've seen a stalling out of technology, really relative to the Dow over the last 4 to 6 weeks, very quietly. I mean,
Right.
We're still seeing tech stocks go up, but you're seeing some outperformance out of the other 493 companies in the S&P.
Right.
Energy, financials, small caps have outperformed over the last month. I mean, in fact, there's meaningful discount relative to large cap and small caps that we haven't seen in decades. So those are all worth, again, portfolio construction wise, those are some considerations.
Taking advantage of those opportunities.
Mhm.
Okay, so it's the last day in July. A month from now when we sit down and talk about August, and really, throughout the rest of the year, people will be finished with vacations. Most kids will be back at school. What's your expectations going forward over the next, quarter and a half?
Yeah. I think it's a tougher sled probably for the second half of the year. From a markets perspective, this rotation we think will continue, where technology pauses out, and the small percentage segments of the market which don't represent much of the S&P will likely continue to play some catch up, which won't necessarily be reflected in the indices themselves, because they're so dominated by tech and communications and discretionary. So we think that continues to play out. And I think, look, there's headwinds that exist. I think banks having to increase capital ratios and all that comes with less deposits and tighter lending standards. Student loans are, the student loan market went from essentially zero to almost 1.8 trillion over the last 20 years. Those repayments are going to start here in the fall. 40 million borrowers, $300 to $400 a month. I mean, that's a factor. We don't know what type of factor. You're quietly seeing energy prices and gasoline increase. That's kind
What
of an
I'm
indirect
hearing
influence.
from you is volatility.
I think so.
Yeah.
Yeah, I think so. We haven't seen obviously much of it for most of this
And
year.
we went 13 straight days of
the
market
Right.
of the Dow, being
Yeah.
positive. I mean, I think that's a unique
Yeah.
moment in time.
Yeah.
So maybe some expectations of volatility, and then we'll see, right?
Yeah.
Economic indications
Yeah.
economic conditions might change.
Yeah.
So.
Yeah.
Well, thank you, John. This has been really a great conversation. I
enjoyed
really
it.
appreciate it. And we thank you for allowing us to be stewards of your wealth. And as always, if you have any questions, please don't hesitate to contact your wealth advisor here at Krilogy. For John MacArthur, I'm Kent Scornia. You have yourself a great day.